Hey, good evening, guys. Ken at Tortoise Capital. This is the Foundations Q&A session for April 24th, 2021. Thank you very much for your patience as we worked our way through the technical connection issue. At 5 minutes to 6, my wife woke me up and said, "Hey, what time does your 6 o'clock podcast start?" I said 6 o'clock. Thanks. Okay, long day on the soccer field today, and I took some painkillers for my tooth implant when I came home, and that knocked me out. So I'm well rested now. All right, so let's get started with this. The first question was from Matthew. Could we discuss the collapsing dragon this weekend? Yes, we can. So I spent a little bit of time, I want to say Thursday night, on the collapsing dragon. Matthew, let me ask you. So I see you on. Did you have a chance to hear that? And did it make any sense to you? I don't know how deeply I need to go into this. Okay, good. Just for those of you that may not have heard the discussion, I went through, it was Thursday night, I think it was. And I went through a flashcard that talked through the supported spring crossing, the owl, the supported fall crossing, winter crossing, and the collapsing dragon as well. So that was pretty thorough. What I really want to say is this. Is that if we had that kind of yin-yang pattern in the dragon, let's see here. Boy, I drew that exactly wrong. Let's see, I'm meant to do it this way. That'll help with the explanation, sorry. All right, so imagine you have this kind of a dragon pattern. There's a couple things that should always come to mind. You would say first, any time that price falls below that line, the belly of that dragon, right? That's a big signal downward. In the same way that this one would be a big signal downward. And that would be a signal to the upside, okay? Because each of these points represents a statistically significant turning point of price. All right. So if I'm going to draw price now as this RL10 as the blue line, what typically will happen mathematically is that the price is going to come down here, and then you're going to get an RLXD moment right here at that green dot. So you can see that even more better. Right inside of that moment right there. Okay. We call that moment the regression line crossing the dragon. Okay. And remember, this RL10 is using the regression line 10 period look back, and it's very adaptive to price. So when it's falling like that, you would see it very tightly correlated with price. And then there's probably some actual swing low price where you have some kind of fat tail and maybe a sell off or something like that. But you have something like the absolute maximum excursion to the downside at that price level right there. Now, a lot of guys that are going to enter right here are going to say, well, I'm going to put my stop right here, because if it goes below that price level, then support is violated. And so you might say, well, I'm going to take this as my risk box then. The problem is, or the opportunity, I should say, the opportunity is that there may not have been much volume transacted here. This was the last guy that sold and the absolute first guy that bought and made that print, that bottom ticker. But when you take into account all of this price action here, you take all of that price action into account. The statistical turning point is here, the bottom of the RL10, which is a 10-period simple moving average plus or minus a half a standard deviation. Or you could say, and I am willing to use the belly of the RL10 as another statistical turning point, right? So in my view, either one of these constitutes a collapsing dragon. By the time the belly of the RL10 is breached, that upward move that we were counting on has certainly failed, and it looks more like the price action that was leading this thing downward. And so the bulk of the guys who made decisions in here to get out of those trades or to adopt a bearish perspective, their true statistical region of decision, if you will, is this belly of the dragon or the belly of the RL10, and not the very last guy who put in this the very bottom tick, right? That guy, there may have been just one guy. So instead of, and everybody made their decision, let me put it that way, everybody made their decision in this region, between the RL10 and the belly of the dragon. So if this price now starts rolling over, it's not heading up here like we had hoped. It's not heading up. It's rolling over. And now this price action, the reasons to sell it there. So what we're looking for is this little downward wiggles. When you draw that line here, any entry below this moment here is a collapsing dragon. And I will accept you using the belly of the dragon or the belly of the RL10. Sometimes this difference is not much of a difference. Sometimes it's 10 cents or 20 cents intraday on a 1-minute chart. On a daily chart, that might be, a quarter of an ATR. The shorter the time frame, the more likely I am to use the RL10. In my view, if you're ever going to take it, you have to take it by the time the RL10 turns. Otherwise, it fails too fast, and then you're chasing. What will happen is that this price starts hesitating as it rolls over and gathers steam, and it might be just wobbling down. But when it breaks below the absolute low, that thing just drops like a rock, and you get an amazing collapse. Well, you don't want to wait for that event to happen and say, oh, it's in the middle of a collapsing price action, let me enter my market order and try to catch it, and you end up getting a bad fill, and you miss all of this move, and you miss this move, and you miss this move. So when I talk collapsing dragon, we're actually treating this moment, the belly of the dragon, as the breaking of support, and then we can get into this thing, and then as it hesitates or fails its way down here and then makes the huge collapse, we're already in the position, and then our job is to, wherever my stop was, is hurry up and get that stop to no lose plus dinner for two and lock in a gain. All right, so that's the main idea behind the collapsing dragon, that the support of the dragon failed and we're getting into the next position. Now, typically the size of the move, whatever that move on the downside was, whatever this move was, we expect another move of that size to collapse. So the market is remarkably symmetrical in that sense. Yeah. Let me try to get my own. Probably easier just to redraw the whole thing. All right, so let me start from right there. So by the same token, if we had this RLXD and it worked, and now it's moving up the stack, and it gets as far as it can get, and then it fails, we have right here what would we call that entry or that moment? We would describe it as an RLXD on this end. And we would see this price level. And we would see that price level as the, the peak of the RL10. Anything north of that, we would call an emerging dragon, or above the hump of the RL10. So now when this price action rolls like this, oops. Now we have another RLXD. That's a good thing. So now if this price were to roll over, what you would see also is that dragon rolling over pretty quickly too. And now we would have another, well, this would be a red line here. We'd have an RLXD to the downside. Now, as I'm projecting this price action, if I'm getting short in that inside this area on the RLXD, why would I do that? Why would I do that? Well, it's because I have a higher high, or I have a high, and then I have a lower high, and so I have this as my primary trend. The confirmation that that thing is going to fail, the collapsing dragon moment, is when that belly of the dragon collapses. So we would call this a pocket entry. The pocket entry would be anything from the RLXD to the actual signal of the collapsing dragon. And that's like front running the collapsing dragon. Because when that dragon collapses here, that typically is going to be a great big red candle that's of collapse that's heading this way en route. And then if this one collapses right here, then this is going to be just a monster of a move to the downside, because you have this price support and this price support both failed. And this distance here, I think, is going to be the size of that move. And I can actually go back and look to see where the next support level based on the belly of the dragon might be. So the collapsing dragon, if there was only one pattern that I had to trade for the rest of my life, it would be that one, because it's awesome. Because you get the maximum fail in the shortest amount of time. You get the maximum fail in the shortest amount of time. And fear is stronger than greed. So it happened. We want it really fast. Well, what that pairs really nicely with the supported spring crossing here, I would consider this one a supported spring crossing. Why is that? Well, because you have a harsh winter, and I'm going to spend more time on that. There was a question about harsh winter to come. So you have some kind of harsh winter that reversed, turned into spring, crossed the dragon, and now you have a very tight risk box here from the belly of the RL10, or where the PSAR flipped. So you have a very tight risk box inside here. You have a very tight risk box from where the RL10 reversed. And the expectation is you can go up until you found, the first burst on this thing will be to wherever the previous dragon rolled over. And if it gets beyond that, it's going to be amazing, right? So my whole job on that one is to get my risk to no lose plus dinner for two, so that I can lock in, if this was my entry here where the RLXD occurred, then as soon as I can get my stop raise to no lose plus dinner for two, I've locked in that little wedge of gains. And now I just turn this into a science project. How far up the stack is that thing going to go? And the harsher the winter on the move down, then typically the stronger the rebound is going to be, because we might think, hey, this harsh winter on the way down, that may have been driven by fear and an overreaction, and then this will be buying on a real opportunity. In the same way, so that's the idea behind the SSC, is you're getting that first recovery after a harsh winter. Well, let's suppose this thing does go up a certain way, and then it crosses the dragon. I may or may not be short that. If I did, that's probably an RLXD entry. That summer would turn to fall, and this could be a summer-fall crossing on the way down, until it gets to a level that it could no longer get to, and then the RL10 reverses, crosses the dragon, and gives me this little RLXD. Now this one is even a stronger signal to the upside, and the reason is it's a kata 2, because we had a low in the dragon here, and I got a higher low here, so that makes a rising low. That makes this one then a kata 2, because it had a higher low and an RLXD. Now, as I'm watching this one, whoops. My job once again, is to have a tight risk box drawn from my moment of entry down to probably the belly of the RL10. So this is my execution risk. And so, yes, my stop is going to be down here. And then as this starts going up the stack, up the price level, my job is to get my risk above. Forward, let me draw that in black. Is to get my risk, my stop level above that point of entry, right? So now what I've done, as soon as I can make that move to no lose plus dinner for 2, I've locked in that wedge of gain. And now, how far up is this going to go? I don't know. The first place I would not be surprised that it would fail would be up here at the peak of the dragon, which was the last statistically significant place that it failed. So if this got up here and started to fail, I'm going to invoke like the 2R battle drill and decide to keep at some amount of this from where I had this stop, that no lose plus dinner for 2 to the peak that it got. I just got to decide how much of that am I willing to give back. The 2R battle drill lets you think your way through that decision. Now, in this particular case that I've scribbled on here, you can see that you had a high, and now I've drawn this as a lower high. Now it feels like this thing is that downward trend, right? And so now I have shifted my orientation to the pocket entry, to the collapsing dragon, and now I'm looking for the next support level to the downside. So these things are driven by that dragon in the middle. The dragon is really your friend. Because what he represents is the reasonable statistical turning points So as I start seeing those kinds of moves, I'm always putting a frame of reference on there, a framework, if you will, that this move is going to be significant. Each of these little moves at the bellies are going to be significant. So when this breaks down and that breaks down and this one breaks down, all of those are going to be collapsing dragons, right? Conversely, if that price were ever to get above this, then that would be an emerging dragon, and then that would be a big, strong signal to the upside. And so would that one be, and so would that one be. These little intermediate positions, though, so when I have, let me get my price now, my RL10, it would have taken, price would have looked something like this. To create a dragon that looks like that. Because remember, the RL10 is also looking at a 10 period look back. So it is computing off the same data as the dragon is, but because it's a faster, more adaptive, it front runs. So when this thing turns, you're saying alert, because this thing is starting to fail, and then the RLXD confirms that thing is failing. That's why the RLXD is a pretty good exit for this thing, especially if you started with an entry down at this RLXD. You end up capturing, if you trade from RLXD to RLXT, you end up capturing that move, right? So that turning point in the RL10 is that first alert. Now you'll notice when when we have that baby dragon, which is a 3-period simple moving average of this thing, that's always going to be like an intermediate. So you can almost think of that as a 1, 2, 3, where you have the peak of the RL10 is 1. The crossing of the baby dragon usually happens a bar or 2 later, 2, and then the RLXD is 3. And you've had 3 signals that this powerful move to the upside is over. And so if you get out at the RLXD, then you're going to capture, again, this move from here to here. Now, this price is going to be falling because it had to draw the dragon that way, and then you get some kind of crossover like that. Now, if I am long on this entry right here, this is an RLXD entry right in here, and then my stop is probably here at the belly of the RL10 or the belly of the dragon, depending how wide that is. One of those two forms your risk box. And then as this is moving up, the first place that I expect it to fail is the last place that it failed, which was defined by the hump of the dragon. So if it moves up the stack and starts to roll over here, there's 2 things on my mind. The first one is, as it's moving up, how fast can I get my stop to no lose plus dinner for 2 so that I can lock in this gain? Now it's a science project. Is it going to go through the previous hump of the dragon? If it fails, then I've really got I've got this choice now. Is it, well, here's the peak that it got to, and here's my stop. So inside of that box is open gains. And my question is, how much of that do I want to give back? Because my stop was here at no lose plus dinner for 2. And price is has moved up here and is now starting to fail, stop. So how much of that box am I willing to give back? When it failed at the last place that it failed. So that's the essence of the 2-hour battle drill, is it failed exactly where it failed the last time. So how much am I willing to give back? That's why I think you got to watch that video, every day for 30 days until you're sick and tired of it. I'm sick and tired of it. I'm sick and tired of listening to myself say it again. But it's essential. The 2-hour battle drill forces you to systematically decide what to do with the open gains after you've already done your professional job of locking in no lose plus dinner for 2. Now, you already know that if you do get out in here and then it goes back through the collapsing drag or the emerging dragon entry, the previous hump of the dragon, well, you want to be long on anything north of that anyway. So even if you get out anywhere in this box and it reverses and goes up through there, you're going to be long that. So you already know where your moment of re-entry is going to be. It's going to be here when it gets above the emerging dragon. Hey, Ken, what if that's only 5 seconds later, 5 seconds after you got out? So what? It's the price trigger that happened. What if this thing monkeyed around down in here for 4 hours and then finally broke out? Well, you would see that as a breakout from the previous resistance level, and you would be happy to get in here. So what's the difference between 5 seconds and 4 hours or 4 days? Time. If you re-enter right after you got out, 5 seconds later, you feel, oh man, I got out too soon. No, you didn't. You got out because the price action at the time, which is all that you knew, said that it was a good time to lock in your gains. Oh, and now it started to resume. I actually love that. Why? Because it hesitated only for a brief moment and is continuing the move that was started with this last powerful leg. So I want to get right back into that. I'm not going to spend time beating myself up saying, oh, you should have known that it was going to go through that price level. Well, how could I have known that? If it was going to go higher than that, why didn't it go higher from this moment? It didn't go higher in here, and it allowed me to lock in again. I'm supposed to know that if I had just waited that long, it was going to resume. You cannot possibly know that. You made the decision to get out when the price required you to get out according to your trading plan. And that same trading plan requires you to get back in here, whether that's 5 seconds or 4 hours, it does not matter. It is the price level that is the trigger condition. So in this whole framework, it is the bends, it's the turning points in the dragon that are giving us those statistically significant areas of interest, whether it's to get short or to get long and so forth. So I want to, in a way, that was like the 2-hour battle drill part 2, second edition, right? So that's what I want to say about the collapsing dragon. It is my favorite pattern. And it is so powerful of a pattern, this CD, that I love the SSC, because if it fails, I'm into my preferred pattern, right? So here's how to think about this as chain trading. Price goes up, price comes back, and now it's starting to cross that dragon again. Now you should be able to imagine where I'm going to draw that dragon. It's going to look like this. That's what he's going to look like. So that RL10 crosses him there, key levels. If that kata 2 fails, right, and this is a kata 2, if that thing fails, I'd love it. I hope it fails. I hope it fails right after I got in, because I'm going to probably get in right there at the RLXD, right where I'm supposed to, because I think it's going to break above those 2 price levels. I'm willing to take that risk and try to front run that, because if it breaks above those 2, this thing is off to the races and running. And what I'm going to do by making this little entry here is I'm going to lock in this period of gains against a tiny little risk inside here. And so now my job, while this thing is going up, is to how soon can I get my stop to no lose plus dinner for 2. So now I've locked in that much. And then if this thing really goes, I'm going to get my second entry in. And that's supported by all of these gains. Those gains are going to support the risk of that second position. And then my stop is going to end up being around in here somewhere. And then how soon can I get that one to no lose plus dinner for 2? And when that happens, I'm really tied into this powerful move. And the size of this move is how far I think it's going to go to the next one. So that move is going to propel this next one if it can get above here. So I'm front running with that kata 2 and with this SSC down here. If that fails, collapsing dragon. So I love it when those things fail. It allows me to be wrong psychologically. That reinforces my guilt, the guilt trip from a Catholic school upbringing. Hooray, I get to be wrong again. But I actually get to be into the trade that's going to be huge. So it's a double win. I get to be wrong and I get to be paid. But when this works, I don't even get to be wrong, but I do get paid. So I'm willing to take that. All right, enough on that. I'm beating that one to death. Okay, so Paul asks about the harsh winter. Is there a minimum fall that it would require, or a minimum loss, price movement? There's a number of things that fail and then recover, but getting back to recent highs look like slim R multiples. Well, I'm going to answer that in two ways. So first on day trading and then on swing trading. So on day trading, the main idea is that from the moment of the open, we define, this is the open. Okay. From the moment of the open, we add plus range stat and a minus range stat. Okay, so that comes from the frog. And it tells you what the maximum reasonable intraday move. Maximum reasonable intraday move is the range stat. It is equal to the average range of the last 30 days plus one standard deviation, which is a frog box. Okay. So whenever price starts moving around in here, right? It starts wiggling around. It goes up, it goes down, it goes whatever. The upper limit of moves is up in here, and so that is typically 2 position sizing risks away. Because if I'm using a frog box as my intraday position sizing risk, and let's just say for whatever reason I'm able to get some kind of entry here, and I have some kind of risk box based on those techniques of the supported spring crossing or the Kata 2, I end up having this this execution risk. This execution risk is going to be like 0.2 of a frog box. It's the implied, regardless of where the support and resistance levels are on the way up here, based on those bends in the dragon from yesterday and today, or the RL10s or whatever, it is intraday. It is the upper limit of the range stat, which defines my maximum reasonable intraday move. And so this is always going to look like there's a frog box to the downside, and then there's 2 more to the upside, at least to the range stat. The range stat is often 3 to 4 frog boxes away from the open. So there is a large implied reasonable move every day that does not require me to go back and estimate these other price levels to get to get my position sizing R. The fact that the range stat is a reliable indicator of the maximum reasonable intraday move. You should say that little mantra every morning. Om Mani Padme Hum, maximum reasonable intraday move, whatever. That's what is establishing the 2 position sizing risk upward bound. So when you minimize the size of your execution risk down to something like 0.2 R, then it's not unusual to see that as 10 risk boxes, 10 execution risk boxes to this theoretical upper limit defined by the range stat and the frog box. Now, the beauty of our little system is here. As long as I know that's there, I'm not worried about the potential that it could get there. Statistics over years and years and years say that that's a reasonable intraday move. It's not, you're not allowed to be surprised if it moves an R stat. If it goes beyond an R stat, then you're allowed to be surprised, because in the last 30 days, only one time out of 6 did it go farther than a range stat on a given day from the open. That would be, by definition, surprising. But if it gets that far, any movement up, if it gets that far, that's not allowed to be surprised. I just don't know how far up the stack it could go. But for purposes of getting my 2 position sizing risks, the range stat acts like this giant magnet. Now what I'm doing when I put these other support and resistances in here, these are all places that I'm also not allowed to be surprised that it could turn. But as long as I've got my stop at no lose plus dinner for 2, again, because I entered at some reasonable level, and now I've got my stop that was here, I've got that above my entry, and I've locked that in, that's all my money right there. I've already made that. So the worst thing that happens on this trade, no matter where I exit, is that I'm going to make some money. So that now turns this into a science project. How far up the stack is price going to go? I have no idea. How far up this price potential ladder is it going to climb before it starts to fail? I don't know. But every one of those things looks like a 2-hour battle drill mentality, because in every case, it will have gotten to some maximum price level. Let's say that it got to here, and my stop is now here because of the RLXD. So how much of this move up the stack am I willing to give back? The 2-hour battle drill answers that one for you. It got to that price level. It didn't get to a range stat. Okay, got it. I don't care. How much of that open gain do I want to lock in? I've locked in this much. So in our view then, the key is, how can I learn to minimize my manageable risk box? How do I manage that move to no lose plus dinner for 2? And then how do I manage my exits on the way up so that I give it reasonable room to run? But when it starts to fail, I have a decision of how much of that extra move I'm going to capture. Lather, rinse, and repeat. If it gets to the range stat and starts going beyond, I'm not worried about that. I know how to add positions later, and I know what to do with abnormal conditions. But if you attend to your business down in here, then it's relatively easy to figure out what to do on runaway days that are going in your favor, where you have a pile of money that's already been made because you were professional in the way that you collected money and locked it in pieces on the way up. That's a good problem to have. Okay. So to Paul's point, that the slim R multiples happen because you're starting to estimate each of these as price targets, and then trying to compute those intraday as potential R multiples, and then you never end up getting the 10R execution risk versus potential excursion. So I'm going to ask you to split your mind in 2. One of them is to always compute that range stat move from the open, so you know what it is that is your upper reasonable limit. Then the second half of your brain, you're looking at these price points where things might fail. Okay, now you're not going to be surprised if they do fail. And then if they don't fail, then you have more evidence that it's becoming a day in which you get a range stat move. So you're just like a little detective. You're just calculating the net gains and losses in there, or an accountant just doing the pluses and minuses. So by all means, figure out where those levels are so that you're not surprised by price failing there, you will have rehearsed what to do. The general rehearsal is the 2-hour battle drill. The key is this thing down in here where you're getting a minimum manageable risk box and then getting to no lose plus dinner for 2. And then you know where your price points are in that price ladder to the upside. And you're locking in pieces as you go. So now the exit strategy is important because that's going to govern how mechanically and reliably and automatically you're raising your stop as price goes up the stack. And then when it fails going up, then that's going to come back and hit your mechanical exit strategy. And then afterwards you can say, oh, it turns out that this was a move of 0.6 R in my favor or 1.1 R in my favor. And it's just a science project. And you don't have to be right. You just have to be managing your rules. Whatever the customer wanted, the customer's the price and all that. Whatever it wants to do, it's going to do. What you can do is manage it and respond to it and do your professional job of locking in gains and taking reasonable risks. So the intraday answer to your question of what to do with those slim R multiples looks something like that. So now let's take a look at the second case, and now this is on swing trades. So on day trades, we were using that range stat as the reasonable. So on day trading, we were looking at the range stat as the way to project those two potential. Now on swing trading, the default would be 2 times ATR. All right, so we got 1 ATR and 2 ATR. By the same token, we might have had, some kind of dragon move that looked, the dragon's looking like that, and price did this. And we got this little entry right here because of reasons. That might have been a 5-day down. And this was the trade frame box that we put on it. And so that tells you where you're supposed to get in. And your initial risk computation might be this. That's your this little piece is your execution risk, because a price that fails below here invalidates the hypothesis that this thing is going up. My hypothesis is that after 5 days down in a row, that may be an over-exaggeration. So when price opens inside here and takes out that high, I'm supposed to get long, and using the daily range or the belly of the RL10 or something in there, wherever you decide you're going to draw your execution risk. Your execution risk is driven off of the context of the pattern for swing trading, just like for day trading. And then for position sizing, you're using this reasonable swing trade buffer of 2 ATRs as your downside. Now, this is a legitimate trade if I can see 4 ATRs to the upside. So 4 times ATR. And then in the same way that the day trade, my job was to get to no lose plus dinner for 2. To lock in that gain. My job here is to do the same thing. Is at some point I got to get this locked in. And once I do that, I've locked in those gains. And now it's a science project. How far up the stack is it going to go? So when I'm doing my initial inspection, how do I determine if 4 ATR was a reasonable upside move? Well, the intraday thing was the range stat. On the swing trade, what I got to look at is previous excursions of the dragon. You know, I can go back to the weekly charts and draw those as upper limits. And so if I get my little entry here, and I can see that I've got my 2 ATRs here, and I can say, all right, to the previous hump of the dragon, there was four ATRs. Then that's where my 2-to-1 risk reward is. And again, beating this thing into the ground, it's not unusual, therefore, to see like 10 little risk boxes to the upside. I might have. That's where you, when you look at the swing trade frame reviews, and we're looking at weekly, daily, and 65-minute charts, you'll see us taking a look at price levels to the upside. You know, say, oh, it could get to here and here and here. And then on the daily, we start adding in all those little price levels. Then when price is going, each one of those becomes like steps or rungs on the ladder that it could be moving up to. But so finding 4 ATRs is going to be by chart inspection. It can also be on the regression line fractal framework, right? Because typically the swing trades we like are ones where the RL270 is way up there, and then the price had been going up with it, and then at some point the price broke down into some kind of series of things and is turning around. And then we can say, well, just by projecting a return to the long-term fair value from here, and there's my little 2 ATRs, this thing could very easily be 4 to 10 ATRs from the RL10 to the RL270, and the RL270 acts as a reasonable upper limit, or this previous RL10 acts. But so the difference between the RL10 and the RL270 acts as a way to estimate forward gains. And so we can use that to decide, is there 4 ATRs? I mean, another simple way to do that is just to take a ruler and say, well, there's my 4 ATRs. Were there any price levels over here that it got to in the past that makes 4 ATR reasonable? Yes. Yeah, there's one over there. Okay, then I see my 4, and then there's the 2 that I'm going to take as risk. Now I can attend to the specific technical details of the pattern that I'm trading. Hey, Ken, what do you do if this thing is at an all-time high and there's no previous price action? Well, then you got to say the fact that it's at an all-time high implies that this thing could go on forever. And I'm just going to take a 2 ATR risk, and I'm going to assume a plus 4 ATR because of human nature. Another good problem to have. It's one I struggle with all the time. Like, oh man, Tesla's at $50 and it's making an all-time high, and there's no previous high that I can project to. Well, just assume that there's a 4 ATR baked into the cake of every breakout to a new all-time high. Just assume that there is, and then be proven wrong. And then get your job is simply take the trade, get to no lose plus dinner for 2, and then suffer. Learn to suffer with gains. Okay, so enough on that. Beating that one to death. I hope I'm recording this. Oh, whew, I am. Good. All right, do we need winter to turn to spring? Yes. On the supported spring crossing. So on the MACD histogram, you have a 0 line. And on MACD, when that thing breaks below the 0 line, it goes until it can't any further, and then it starts to roll over. I'm going to draw this as gold instead of yellow so you can see it. And it becomes spring, and then spring becomes fall, becomes summer, and then summer becomes fall. And the cycle repeats. So yeah, you need to see this thing go from winter to spring. This means the MACD was negative. Yes, that's true. Now, the other place where life is good is when you have summer turns to fall, but it doesn't stay fall very long and starts to reverse, and then it becomes quickly summer again. This is wonderful. Summer, fall, summer is an automatic buy, because that's what happens in kata too. When you have these long grinding bull moves, you get things like this all the time. And it just keeps happening. You just keep locking them in, keep locking it in, summer, fall, summer, and then every so often, bam, COVID. And then it goes, right? That's what, so you love summer, fall, summer. Intraday, what you want is the harsh winter turns to spring, and this is where the SSC is going to be found. And then later up the stack, it's going to be the owl. And then if this thing goes up, down, and up again, so spring, winter, spring is a good thing. That's an indication that it's lazy Wing its way up. But the one you really want for the collapsing dragon would be winter, spring, winter. Oops, that should be red. Winter. That's the one you want, because that's like a collapsing dragon, and the size of this one is the size of that one. This is where you had something like, this is shown on MACD, but if you looked up at the price level, you'd see this is where you got SSCs that failed, or you might have an owl that failed. And this trigger here, you would end up seeing a lot of collapsing dragons happen, and that's what you love. So these little summer, fall, summer is great for a grinding bull. Winter, spring, winter is great for violent winter fails, falling through the ice. The next question was, do you need to see the PSAR flip? Yes. Because that's a confirmation. So generally speaking, when price is failing and then price starts recovering and then is going to become great, that PSAR would have been trailing all the way down on those nice long smooth fails. Somewhere down around at the turning point, the PSAR will have flipped, and now you're getting these nice long moves to the upside. I want you to think of that space between the PSAR flips as that kind of a yellow zone in which the transition from the fail of the winter into a tentative spring and then into a summer happens, right? So in the SSC, you need to see a harsh winter. You need to see the RL10 bottom out. Then it's going to turn to spring, and then it's going to cross the dragon. And then when the PSAR flips, bang, there's your entry and there's your risk box. So you need to see that. Now, one of the things that we have learned is that a lot of those turning points feature a large explosive move off of that swing low, and you get some kind of a great big wonderful set of bars like that right in a hurry. And it's often that PSAR dot that was coming down here, it takes this long for it to flip, so you don't get the flip till here, and now you're saying, oh crap, I'm buying in here, and now look, I missed it, all of that. So one of the things we like to do is when that is coming down the harsh winter, we start looking at if this is where the last PCR, I go to the second to the last PCR and say, well, if this thing rockets through there, I'm just going to get long and use the belly of the RL10 as my risk. Oh, it didn't flip yet. Okay, then I'll just, so I start marching this thing like a surprise limit order. It's like if you were using the PSAR as the trailing stop for this long winter move. You say, well, I'm just going to keep using the trailing stop. Oh, then you can use that as the trigger to get long. So now if it does violently move up through here, you could get long at the second to the last PSAR dot, and then you'll get surprised into that position. So you might use the PSAR dot as the exit, and then the one just before it as the entry. So you might have the exit and the entry. And then somewhere in this explosive move, the PSAR dot will officially flip, and now you're into the trade. We've discovered that that's a refinement. If you end up using the SSC a lot, after 1,000 trades, I will allow you to do that technique to anticipate the turning of the flipping of the PSAR. All right. Where the PSAR draws is when the RL10 is moving down and now it has started to reverse, the level of the RL10 is where that PSAR dot is going to flip. So when it does flip, bang, now we got the price move that took it up and beyond. The place where that thing flips is going to be the max excursion of the RL10. So you know that's where the PSAR dot is going to draw when it does flip. And so wherever you get in, that's what your initial risk is going to be. So you always know what that initial risk is going to be because it's the belly of the RL10. And then if you end up adopting that idea of the descending PSAR as the surprise entry, you always know where that thing's going to flip because you have the reference point of the previous RL10 excursion. Okay, cool. Is there any requirement, this is on the SSC, is there any requirement for a long-term trend is the next question. Yeah, the long-term trend that you care about is the harsh winter. The fact that it's a harsh winter is that longer-term trend. That's as far back as you need to go to justify this as a supported spring crossing. Now, however, if you're using, for example, like the weekly, daily 65-minute chart, or you're using a 1-minute, 10-minute, 30-minute chart as short, medium, and long term, yeah, knowing where the dragon is, all you got to look at that is where's the dragon and where are all those humps, and that'll tell you, how harsh that winter was. Or was this thing a rising dragon on the 30-minute or the weekly, whichever your long term was, and then there was some retracement that turned into a harsh winter and it has now started to reverse. Yeah, I mean, you care about all of this because you think if this thing goes, it could be just like this long move. So yeah, longer term, you're looking at those things. But what you really want to consider as the primary trend for the supported spring crossing is that there was a harsh winter. Like there's no doubt in your mind that that was a harsh sell-off. That could have been something that was pushing way up and then pulled all the way back to the Bollinger Band mean and the MACD turned harsh. That's enough of a primary trend to create a harsh winter on intraday. Yeah. Number 5, price moves aggressively off a recovery from weakness. Is there a limit on distance from the dragon or other reference point at which you would leave the trade alone? And that really is a question that is answered by this discussion about This contingency entry of using the descending PSAR is a way to get surprised into those. So if you do have a strong move off a recovery bottom, that you're still into it, and that's fine. That sort of prevents you from experiencing the angst of saying, man, I wish I'd have gotten into that one. Well, first of all, if you find yourself wishing you could get in, stay out. I would rather be outside wishing I was in than inside wishing I was out. But this gets into dragon theory once more, and I'm going to look at it like this. And remember, when I'm getting into that thing, price ended up looking like this. Actually, the more times you draw that, the more often you end up seeing it in the world, right? So I don't even have those. That's just places I'm projecting the dragon to be. I hope it's going to do that. But at the time I entered, it hasn't done that yet, because all I knew was that I had my little supported, I had my supported spring crossing right here, right? I had my supported spring crossing. So the emerging dragons, those two price levels there, the hump of the dragon and the hump of the RL10, both of those are emerging dragons, right? Because if price were to get above that, then as soon as it gets above those, you say, oh, then all of this adverse price action is negated, and it's as if this whole retracement didn't even occur, and it's just continuing the previous trend up. It just got displaced in time by a little bit. So I'm always, this last little excursion above the RL10, to me, is the entry of last resort, right? Like, I have a reason to get in at the RLXD. I have a reason to get in on the OWL. On the intraday trade, this might have been a frog box move off the low. So if it's a full frog box off there, I have a reason to get in here, because that's a non-noise move intraday. And as long as the range stat move is still way up here, and I can still see one, yeah, I can get in. So the real answer is, that's the early entry, the owl entry, a frog box entry, the first emerging dragon, the last emerging dragon. If you're not into it by here, one of the things you can say is just, well, okay, just buy it and put your, whatever the minimum manageable risk box was down here, just put it on right there and just say, well, if it falls back below there, then I'm out. But if you're not into it by there, the regret entry, move on. So I want to tune myself to here. My problem is wanting to get a, price is coming all the way down and ends in a little doji. Then there's this little one in here. I'm already looking at this as a 1, 2, 3 entry, because here's the swing low in price. This one made a new high compared to the high of the doji without making a new low. And then this one opens and without making a new low takes out the high of bar 2, and that's a 1, 2, 3 entry. That will often happen inside here without even waiting for the RLXD entry. In that price action, the dragon is here, and it might be the 4th or the 5th bar that has caused the RL10 to be strong enough to cross the dragon and give me an RLXD. So my problem is getting in too soon. All right, so I'll just live with that. But at the other end of the spectrum, it's really the emerging dragons that are sort of the last train leaving the station for routine travel. Anything beyond that is a kind of a regret. The other thing too is you might just have to go up one time frame. And so if I missed it on the 1 minute, maybe on the 3 minute, it's still early enough, and then you just are using the 3 minute bars. Now that means that your execution risk is going to be wider. That's fine. And that means your position sizing box is probably, or your position size is probably smaller, but that's sort of the deal. And then to Paul's questions, this was all about the the problem of seeing 10 execution Rs, and that's because of the, looking at the price ladder on the way up, and individually these don't support, the big two position sizing are, when you have a small execution risk, and that's why you're using the range stat as that upper limit for the two big frog boxes of moves, and that'll solve that problem that you have in there. And so, and so what this actually translates to, because my average win is 0.6, my average loss is 0.2. Yeah, I'm aiming for a full 2 position sizing, but normally that equates to I had 1 execution risk, and then I had 2 execution risk gains, and then it wobbles it, and then I ended up taking a couple scoops. Yeah, that's fine. Aim for 2 full, and then take what you can get based on the science project. All right. So moving on. For Paul, yeah, you may end up getting to the point where you get comfortable looking at the 2 execution Rs, and then be prepared to let it ride if it goes past that. That's where you end up getting to in this mentality. But psychologically, it becomes very easy to do that when you've gone through this math and you're ready to execute the 2R battle drills. That's what you're going to end up getting to. It's almost impossible to get there right off the bat because people are trading at a position size driven by the minimum manageable risk box instead of the position sizing box. The problem with getting really comfortable with this is that your position size, when you set the 0.2 equal to 1 full risk box, you end up getting 5 times larger, and then that affects your psychology, and you can't stay in the game long enough, calm enough to let the skill of thousands of trades make it automatic. Does it take thousands? It takes 600. That's what we discovered with Kim Anderson and Matt Blankenship and Alex McKinnon. It takes 600 to 1,000 trades performed routinely before you have internalized the muscle memory. How many times has Ronaldo juggled a ball? So that it looks automatic. Yeah, because he's juggled it millions of times. But you have to try to juggle it in the same way each time in order to build the muscle memory and learn. If you're always changing the rules every 2 or 3 trades, you never get it. Each one of them is a false start. You're not giving skill the time that it takes to simmer and cook. All right, Juan says, I went through the Foundations course. I feel I should do the course again to make sense of the different areas and subjects discussed. Will I lose any of the content or get behind the training sessions if I redo that over the next 2 weeks, or should I continue into the training? I would say take it again until you have really feeling it in your bones, and then tentatively just trade the supported spring crossing and collapsing dragons, and paper trade those. Then start trading 1 share a day. I'll tell you how much back testing and paper trading I did with my daughter. 0. The first thing when she was ready, I taught her those patterns, and she put live money on 1 share and just get in with it and get right into it. I would keep retaking the foundations until you feel that it's locked in, and then learn by doing with paper trading and forward trading and posting the trade frames and the trade conclusions in the chat room. And that's how you start building the skill. and the skills that and patterns that you're building towards, like if you were in the hybrid trading, I would, to me, the supported spring crossing is the first one to practice, because when it fails, it becomes the collapsing dragon. When it works, it leads to, you'll end up seeing the owl, and you'll see kata twos and all of that. And then when it wiggles into sideways quiet channel, you'll realize, oh, don't trade sideways quiet channel until it becomes a Z3 pinch. And then you can trade that one in either direction. And then that will lead to supported spring crossings on fails and recoveries. And then when this succeeds and fails, you'll get kata twos or collapsing dragons. And then that Z3P ends up teaching you how to, right from the open, trade the hybrid frog, because we treat the opening as a Z3P with a very tight risk box, and we trade it in either direction. And then when it fails large from the open, then that leads to harsh winter, supported spring crossing, and then off you go on every time frame. When you're swing trading, you'll realize that that same kind of operational framework you can trigger with channeling signals, overreaction, washouts, triple screens, auto framers, 551Ws, 5-day downs. All of these act as reliable swing trade initiators that you can then start interpreting with this operational framework of collapsing dragons, supported spring crossings. And these just get you started on the swing trade in the same way that the open itself does every day. Every day starts with a Z3P, because it's from the open, it can go up a range stat or down a range stat, and then we're going to see these patterns start to emerge throughout the day. The supported spring crossing is the easiest one to see, because why? Because you had a harsh winter that has reversed, and now it's going to come back to some measured level, and I have a minimum manageable risk box, and I can shoot for an upper plus range stat. And now as soon as I get my stop to no lose plus dinner for 2 and start locking in pieces, off I go. So stay with the basic concepts until you get that locked in. I would start practicing paper trading with the supported spring crossing on EWZ and DIA, because that one is an aggressive index and one is a conservative index, and they both have futures, and they're both liquid, and they are great places to start. Next one. During the Foundations course, I found it curious there's no mention about using volume beyond using the VWAP. I don't use it. I haven't used it for 40 years. It's not relevant to me or any of my systems. The VWAP is the only volume information that I need, because it acts like a price magnet for settling the intraday trade. That's just the way I trade. I've never used volume. Don't need to use volume other than the VWAP. Matthew says, if we were to trail with the Bollinger Band mean, would I set that as a technical stop, exit when it crosses below the Bollinger Band mean? Yes, that's the managerial exit. Or set a price of where the Bollinger Band mean is at the point of entry, and then trail with that price amount. That's a technique that's not dissimilar, although I don't specifically use that. And the reason is, on the supported spring crossing, the Bollinger Band mean is north of us. If you think about how can we get a supported spring crossing entry, it begins with, hey, there was a harsh winter that has slowly returned. When you go up and look at price action, you'll end up seeing that the river looks like this, and the Bollinger Band mean is in the middle of it, and it's coming down. And this harsh winter, those sharp sell-offs from like a Z3P breakdown, and it failed, that vicious price action to the downside that then terminates here and then starts working its way back up, you'll see that the dragon will have left the river at some point here. The dragon is outside of the river, something like that. And now the price action that's getting us in, there's our trigger for the SSC. The PSAR will have been, the way that thing is, the mathematics of it looks like this. And then when it flips, it'll be down here, co-equal with the bottom of the RL10. And so we're setting our risk box, or execution risk box there. The Bollinger Band mean is up there. In fact, that thing is often 2 risk boxes north. So when this trade works, it looks like this. This thing just keeps going and going and going. And at some point, what you'll see is when that happens, the PSAR gets above our entry, and then when it gets 1, 2, 3 bars above our entry, on the Wu-Wei exit, we keep this in place, and then when we get 3 PSAR dots above, then we jump to here, and that's where we lock in no lose plus dinner for 2. And then we keep that in place until the Bollinger Band mean, oops, that should be red. The Bollinger Band mean, it takes the river this long to reverse. And then when the Bollinger Band mean picks up and starts going, then we adopt the Bollinger Band mean. So the normal condition for the SSC is that we're aiming for a return to the Bollinger Band mean. So this is a mean reversion. And then the idea is that's one leg. You're going to get another leg beyond that. So this thing can easily go to this price level, to the far side of the river. So the far side of the river in this trade setup looks like this. So you're getting these turning points beyond the floodplain, certainly beyond the river. It may be out here by Z-3. So you've got 3 sigma move just to get back to the Bollinger Band mean from here. So that's the first leg. What happens at the Bollinger Band mean and it starts to fail? Well, if I've already locked in no lose plus dinner for 2 and it starts to fail, that's just the 2R battle drill. How much of that do I want to keep? Oh, you got out and then it starts to reverse and go, okay, I know how to get back in. Kata 2. And repeat. In the 2R battle drill video, I discussed 2R as the first place I would add a second position. Yes, until you get 1,000 trades in, wait until you have 2R in hand before you add the second position. Now, for training and instruction on how to do that, look into Patreon on those monthly index summaries of the nightly podcasts, and look for any one of those that says bar by bar exercise. And you'll see the traders practicing these techniques about when to add second positions. And that's part of the advanced training that we do. But until you get 1,000 trades in and you have mastered this, don't be fiddling around with second positions. Where you end up getting to is, for example, what if you get a Kata 2 before you get to 2R? Could you add? You could, but now you're into advanced techniques, and let the buyer beware. Now you got a power tool with radioactive fuel. Watch some of those watch all of those bar by bar videos and play along with them and start practicing that technique. Because then what you'll find is you can break your initial entry into smaller pieces, enter earlier with the SSC so that you're not nervous, and then add the second piece at Kata 2, which constitutes your full position. So that's how I teach that. Don't get larger faster, get smaller faster. Get your first piece in at the supported spring crossing. Very calm. If that fails, you're into the collapsing dragon with a full position. I love it. I took a minimum risk, and then I'm into the preferred position. Then when you get a Kata 2 and everything looks like it's working, Kata 2, put your second half of position on. Then you'll get the average price and you'll be good to go. Watch the bar by bar exercises. Final one was, I would love to post trade frames, but how can you do this if you're day trading on a 1 minute chart? If you're day trading on a 1 minute chart, I don't want you posting trade frames in the chat room. I want you concentrating on the position, because you only got 60 seconds to reset, refresh, manage, and all that stuff. Mark up your charts and post it after the fact from the live trading. That's like, dude, if you're in there, if you were doing heart surgery on 1 minute charts, I want you working on the heart, not posting a chart so you can put it in the chat room for other people to discuss. What they can't tell you anything in time to make a difference to your trade, so post it after the fact. If you're doing swing trading or trading on hourly frames, you'll have plenty of time to post the setups. But if you're trading on 1 minute charts, trade your frames, record them, post the charts later that shows what you did when the smoke is cleared. Focus on the task at hand. Okay, so that's everything. Thanks for hanging in there, guys. We got the swing trade session to do next. So I'll get this published and posted in the usual spot, and we'll be hanging that in Patreon, and then also on in Basecamp, and very good set of questions. It's clear to me from the quality of the questions that you understand the basic ideas, and now you're starting to refine your understanding at key checkpoints, and that tells me you're doing the work. So well done there. I'm going to terminate this one then, and then go start the swing trade patterns. Now, hopefully, a bunch of guys have posted swing trade patterns to consider, so that we can take a look at those. And if not, I'll get to go take a nap, take some more pain meds, and back we go. So, good session, well done, and we will see you in the chat room and in Nightly Strategy Podcast and on down the road.